may be the silver lining of inflation.
Okay, Andy Jassy's had an all-hands meeting. Amazon is freezing hiring for corporate roles in its retail business. Almost 90 VPs or higher level execs have left Amazon since 2021. Earlier this week, there was an all-hands presentation, and the slides were leaked to Business Insider. Some of them: constraints breed resourcefulness, self-sufficiency, and innovation. There are no extra points for growing headcount, budget size, or fixed expense. The slide instructed employees to accomplish more with less. Sounds familiar. Sounds like something the U.S. needs to do and foreign policy needs to do. Amazon leadership team urged employees to double down on frugality. Jassy also spoke in the meeting. Just a couple of quotes, and then I'll get your thoughts, Chamath. It's on a lot of people's minds, and of course, none of us know for sure what's going to happen, but there are a lot of signs that point to this being a difficult and rough economy ahead of us, and I don't know how long that'll last. But I think it's one of the things that we are thinking about, and we've decided that we're going to be more streamlined in how we expand in 2023. Good companies that last a long period of time, who are thinking about the long term, always have this push and pull. Chamath, what do you read into this?
I'll say three quick things. One is that today, Thursday, October 13th, we had an inflation print which was worse than expected, and the markets are materially higher, right? So,
Strange. Why?
Well, we talked about this a few weeks ago, but my thought then, and it's the same that I think now, is that we've effectively seen the near-term bottom and we're now consolidating. And so every opportunity people have to justify that most of the news is behind them, they take and they use that as a reason to buy. Okay, so that's number one, which is that we are sort of near the end. The second, however, is that if we do see another leg down, there is really only one cohort of company that hasn't been really whacked. And I'll summarize it very quickly by saying it's Microsoft, Amazon, Apple, and Google. That's it. Even Facebook has now been sort of put into the bucket of everybody else where, we've been crushed 60, 70, 80% in those companies. So what does that mean? Well, those four companies are now being identified for what they may be, which in capitalism is called over-earning. Okay? They are making more money than we think is appropriate. This letter from Andy Jassy is his way of effectively telling his major shareholders that he is now moving the business to become more of a cash cow business. Tim Cook made this incredible decision in 2016, 17, 18 that effectively did the same thing. That's when Buffett came in. That's when he established a huge ownership in the stock. That's when the stock absolutely ripped because it moved into a different bucket in people's minds. It became growth at a pretty reasonable price. And I think Andy is making the case that Amazon is going to become one of these GARP stocks, growth at a reasonable price. He's going to generate a ton of cash flow. He's going to keep expenses nominal. He's going to return a ton of cash to shareholders with buybacks. That's the reading in between the lines of that letter. I think it's a really profound statement and a very smart move because you haven't seen that letter or a version of that letter yet from Microsoft. And you started to see hints of that letter from Sundar, where he said, it's and he's
saber rattling.
He's not there yet. He's in the appetizer part. He's in the amuse-bouche where he's like, guys, you got to work harder. Hey, guys, let's create some fancy acronyms. But Sundar's got courage. No, but he's got courage. He is going to rip the Band-Aid off too. And so I think what it means is these three and maybe these four companies are going to draw a hard line in the sand and say, we are not over-earning. Do not abandon this stock. That, again, will help put in a bottom in the stock market.
What do you think, Freeburg? You worked at this company and, the principles across the board. The saber rattling will turn into saber swinging in Q4, Q1, you think? Google, Apple? Cuts coming?
Amazon is affected in a different way because they operate this physical supply chain business. They're delivering goods to people's homes that people are buying. So they really have to change their trajectory very quickly. It was incredible. You guys remember when COVID hit, you tried to place an order on Amazon, it was like 3 weeks to deliver because the infrastructure wasn't there to do it. So they actually were seeing more orders than their system had predicted. And they did massive build out. They hired, 1 million people or something in their network to meet demand. And then over the next year, earnings went through the roof. Their infrastructure and employee headcount went through the roof. And now we're obviously coming back down the other side of a mountain, and they're having to shift strategy and shift their operating model yet again. There's a broader set, and that's because they're in the direct commerce business. Microsoft, Google, and other kind of software companies, some of which benefit from advertising, which is almost like a first derivative on the consumer market, or a first derivative on the spending of companies that sell to consumers, have a little bit of a different calculus. They're a much higher margin business, 30% EBITDA kind of business, with EBITDA margin business, with a very distinct kind of set of challenges on how advertising revenue is going to be affected over the next couple of quarters, and balancing that against their cloud platform, which is sold to enterprises, and their media consumption platform, which is generally like YouTube at Google's case, which is less affected. So it's not as much of a direct calculus. I will say what's happened over the past decade, which we're now seeing change, is these companies have had extraordinary growth, hiring people to no end. There's always been, kind of this extended expense on capital, on human capital. And that expense on human capital has driven the average cost per employee through the roof. And it's not just the salaries. It's the cost of the RSUs. It's the cost of the facilities and the free ice cream and the gyms and all the other stuff that's gone on to compete. That's now changing. And so it really is creating a different model for operating that hasn't existed for the last decade, where everything has been, how many more things can we throw in the kitchen, throw like the kitchen sink at this problem to get all the human capital here? And I think that's really, what's going to kind of structurally change in the Valley. It's not as acute as what Amazon is dealing with.
It does feel like those are the last cities to fall, Chamath.
They are the ones that take the index to 3,200. If we're going to try to do it, there's only one place to look. You've whacked everybody else. Everything is down, 50 to 90% in some cases. So
and then finally,
and by the way, sorry, just at the end of last year, a quarter of every S&P dollar was crowded in those names. A quarter. So you got to go there.
Yeah. I mean, and also they're automatically bought, right? They're automatically bought by these index funds. And so who's at the wheel saying, we're going to take the money out of them, right? Who in their right mind is taking money out of Apple, Amazon, and Microsoft? Where do you put it? I guess is everybody's question, right, Chamath? Like if you take it out of there, where do you put it?
Well, no, I think it's just that when you have patterns of selling, typically, as I've seen it, my experience is that initially it's the algorithms that really start to push a market in a direction. Then you have, the more traditional fund complexes, that's the hedge funds and the long onlys, they follow suit. And then the last group tends to be retail. And it works in reverse the other way as well. And so, obviously there's exceptions to all of these, but as a general rule.
So if retail starts bailing on Amazon and
they are right now.
And Apple, yeah.
They are sellers now. But
so
again,
now time to buy it, right?
But again, this is where sort of organized capital now is finding a bottom. Again, like when you start to shake, just think about the psychology of like being delivered bad news after bad news. You go through the cycles, right? There's denial, there's anger, there's depression, there's bargaining. But then at some point there's acceptance. And in that acceptance phase, you're like, yeah, you're right, things are bad. But when you see a market rally into a print like this, it's really, really interesting psychological turning point.
As a proof point to what you're saying, Sacks, Chamath, and Sacks, I want to get your comment on this. Venture capital firms like Sequoia, Excel, and others that have now changed their status as, just private companies, but also dabbling in public, are buying public equities, which basically means they see more opportunity in public, underpriced tech stocks, growth stocks, et cetera, than they do in late stage private companies, correct? And you saw the Wall Street Journal story, I'm assuming, Sacks?
Yeah, I saw that.
What do you read? What's your read into that? Is it overblown or is it indicative of something?
I think it's probably overblown because Sequoia created that fund that is a hedge fund, and Andreessen Horowitz became a registered investment advisor so they could buy public securities. So look, I don't think most venture funds are all of a sudden investing in public markets. We aren't even allowed to do that as far as I know, nor would we ever try to. So I think probably it's exaggerated.
You have to give up Sacks your VC exemption, but you could do it.
You could do it, yeah.
Yeah. I mean, we wouldn't want to, but it's kind of the point. But look, I can't explain why the market did what it did today. It could have, like Chamath said, it could have been some sort of algorithmic, buying or selling. But I just think that the overall news today was the economic news was just another really bad report. I mean, just look at these headlines from the New York Times today. Okay, I'm going to read you the headlines on a single sort of scrolling page here. Number one, inflation came in much faster than expected. Bad news for the Fed. Takeaways from another painful inflation report. 3, disappointing inflation data keeps Democrats on defense ahead of midterm elections. 4, food prices climb again, weighing on household budgets. 5, rent inflation remained tepid, a troubling sign. 6, used car prices aren't declining as much as economists had hoped.
Slow down. 7, give Freeburg a chance to take some Xanax. Take his Xanax, Freeburg.
Yeah. Gas prices fall slightly, but overall energy costs are soon expected to rise. And 8, retirees are getting an 8.7% Social Security cost of living raise, the biggest in decades. I guess that one is sort of positive, but it's like literally negative headline after negative headline
totally.
in the New York Times.
But can I reinterpret that for you? I think the way to think about it is this gives the Fed the resolve it needs. It's going to go by 75. It's probably going to go another 75. We're going to have rates by 4 to 4.50 to 5%, probably within Q1, which means if you're trying to figure out where the bottom is, it's roughly nowish. And so that's why you see smart money, David, shaking this thing off and starting to enter the market. And so again, and the other version interpretation is when rates are 4 or 5%, the cost of servicing United States debt is so meaningful as a percentage of their budget. The incremental spend that they would need to make to enter a new war is too much, I think.
I love this point. We're weaving all these things together. Do we want?
Yeah. Well, look. Right. So on the economics page of the New York Times, it's just disastrous headline after disastrous headline. Then you turn to the foreign policy page. You got Tom Friedman writing a column here saying we are suddenly taking on China and Russia at the same time. And Tom Friedman historically has been a huge hawk. And he is even saying...
He's saying pump the brakes.
Yeah, pump on the brakes. Never fight Russia and China at the same time.
Yeah.
So he says we are in uncharted waters. I just hope these are not our new forever wars. It's like, whoa. So basically, look, our economic base, our economy is crumbling at home at the same time that we are doing unprecedented saber rattling abroad. This does not compute. We need to take a time out here.
My prediction,
no
I agree
mention of
with
Iran.
you, but my prediction is that we will not enter a new war with rates flexing up as aggressively as they are.
I love it. I love weaving these two stories together. I think it makes a lot of sense. We didn't have time for Alex Jones, but we'll save that for another episode. Gentlemen, I think it's our best episode ever. It's an honor and a privilege to spend this hour or so with you every week. I love you like brothers. And it's been a great 100 episodes. I look forward to 100 more. Sacks, if you need a mental health break, talk to Friedberg's psychiatrist.
No.
He's got him doped up.
David will be back next Friday. I just want to say...
Turn off replies, David. Don't read your replies. Get off of that.
I just want to say how much I love you guys, and I'm really proud of what we've created, and I'm really excited to get to the next 100. And I'll see you guys tonight. I'll break out the white truffle.
You want to keep going? That's the news today?
I'm in for a hundy. I'm in for a hundy. I love you, Sacks.
I will say that Jake House moderation's been a lot better since he got brigaded.
That is his way of saying he'll see you next Friday.
All right, everybody, let's see. It's been 100 episodes. I love you, Chamath. I love you, Freeburg. Let's see if we can get Sacks to do it. It's been 100 episodes. He hasn't said it yet, but I love you, Sacks.
Davids, are you coming tonight? Saxy, are you coming tonight?
Yeah, I'll come.
You're coming?
Oh, wait. Let me check. I'll get back to you offline.
Oh, Jesus Christ, God, Jesus.
All right, but hold on a second. Sacks, I love you. Let's see if we get him to say it.
Okay, Saxy, I love you.
Back at you.
That's 2. Sacks. Going around the horn.
Back at you.
Freeburg, can you say I love you too? Can you say I love you?
I see you. I see
David,
you.
I love you.
What did you tell Coolio?
Freeburg, I love you.
I appreciate you.
Oh, you appreciate. Okay, we got to back at you, and I appreciate you.
You guys,
that's 100, baby. You. That's 100. We'll see you for episode 2. I love you too, Chamath. I'll see you tonight.
Bye.
We'll let your winners ride.
Rain Man, David Sacks.
And instead, we open source it to the fans, and they've just gone crazy with it.
Love you, Besties. Queen of Quinoa. Besties are gone. 13.
That's my dog taking a notice in your driveway. Sacks.
Oh, man.
My haberdasher will meet me at Clinton.
We should all just get a room and just have one big huge orgy because they're all just useless. It's like this sexual tension that they just need to release somehow.
Wet your beak. Wet your beak.
Wet your feet.
We need to get merch.
Besties are back.
I'm going all in.